first thing I want to share with you about how the market moves so violently in one direction. At first, it doesn't happen very often that you get kind of the mother of all squeezes, is what I call it. The other Michael and some other members that have been with me for a few years remember a few other times when this has happened. Sometimes we've capitalized on it because we were just in the right place at the right time. But most of the time, we stay out of it. And it usually happens after we've made a ton of money on a downward move, usually. So if I don't participate in the giant squeeze, I have no FOMO. I may lose a little bit of money if I was short, if I was net short and the squeeze happened. But because I am very disciplined as it relates to allocation, and because I teach you to be disciplined as it relates to allocation. Talked a lot about this last week. In last week's sessions, we talked a lot about allocation. When it happens, I don't care, but I want to explain what it is. So the first part to understand is the role of the market maker, because the market maker does participate in the mother of all squeezes. That is only one part of it. So I've explained this before. Those of you that have CTV understand this, but for those that are fairly new to this conversation, I'll keep it brief as much as I can. I'll answer questions, but it's really a very simple concept. And the concept centers around what actually moves the market. Some say Trump tweets. Some say market data that comes in on Tuesdays, Wednesdays, Thursdays. Some say the jobs report. Some say it's news out of China. Some say it's tariffs being put on moves the market. The unemployment rate, the bond market, the credit market, Goldman Sachs, Apple, Nvidia. And so you're all right. Everything has news that comes out moves the markets. Yeah. What I'm about to share with you is a conversation that no one else will have with you. Some of it, as a disclaimer, is my opinion. You can take it in any way that you like. If you listen to me like you're listening to the gospel, okay. If you listen to me with skeptical headphones on, okay. So what I'm about to share with you, part of it is fact and part of it is my opinion and what I've witnessed and what I've experienced. I'm not going to tell you which is which. I'm just blending it all together into this conversation. Okay. So this is the disclaimer. So if anything I say, you look it up. Well, Michael said da 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 da, and what okay. I don't want any flashback on it. So. Just giving you a little disclaimer, which is going to save my email inbox. Alrighty? But those of you that have been with me for a while know what I say in terms of this conversation to be true. They have witnessed it. They have seen it. And yes, they have traded it. So here we go. What really moves the markets, in my opinion, the options market. And the reason I say that is because, and I'll explain what a tweet or news or data, what effect it has, because it does. It does cause little spikes and drops and things like that. But what really moves the markets, there are algorithms keyed to the dollar. Yes, that does move it up and down. There's algorithms keyed to overbought and oversold conditions. Yes, that's true. They're keyed on the VIX, they're keyed on the dollar, they're keyed on the yields, they're keyed on Bitcoin, they're keyed at certain option volume levels as well. So I'm not going to talk about all that kind of stuff, but what I am going to share with you is that when options traders buy out of the money calls, but a lot of them at a certain level, the market maker has to then respond. So the market maker is buying calls and puts, is buying stock, buying and selling stock on every symbol all day. It's billions of dollars a day. Maybe it's even trillions in and out over the course of a week. So when you buy the $200 call on Apple, let's just say, making it up. Do you buy the $200 call from Apple? Does Mr. Apple sell you the call? Does some dude at Goldman Sachs that's sitting on a bunch of them sell you who sells you the call? You're buying something. It wasn't just fabricated, oh, there's this thing called a $200 call. You're buying an asset. You're buying something. You're buying a contract. Who are you buying the contract from? Conversely, if you want to sell the $200 call after holding it for a week, who do you sell it to? Back to Mr. Apple? Or is Mrs. Apple in charge of the purse when selling Apple contracts? So this could be me buying. This could be a hedge fund that has 10,000 shares that are selling blocks of them, to a clearinghouse, a brokerage, whatever, and whatever. They're selling, I'm buying, it gets to me somehow. What do they want? They want, $4.20 for it. I want to pay $3.50 for it. This is called the ask. This is called the bid. You've seen it in the options chain, have you not? I'm bidding $3.50. They're asking $4.20. There's a mid price in the middle, right? At around what? $3.85-ish is like the mid. So I see I'm not getting anywhere. I see the mid price between what they want and what I want is around $3.85. So I change my buy, my limit order, so to speak, to $3.80. Let me see if I can get $3.80 for it. And it sits there. Doom, doom, doom. Nothing's happening. So I changed my price to $3.85. Order filled. Boom. Yay. Well, and it happens instantly, right? So this back and forth negotiation, how are they going to get their money? They're in Cincinnati. I'm in Charleston. And so does it go from like my brokerage to their brokerage? But their brokerage, they're based in Cincinnati, but they have a hub in New York and London and how does the money go from me to them and the negotiation back and forth? And if there was an entity that paid them, because they're not going to release it until they get paid. Well, I'm not going to pay it unless I have it. When I buy it, I want to have it right away. So there is an entity called a market maker. Big company, Citadel is one of them. So they're sort of in the middle of this negotiation. And they go, Michael, how about $3.85? You want $4.20? They go back and forth. It all happens in a flash. Anyway, the money is taken out of my account and then somehow transferred over here. There is a go-between. They do make a little money. Maybe they make a penny or two on the transaction. But there is an entity that provides liquidity to the market that allows for this business to take place. Now just multiply that times every stock purchase, every options contract. It's insane to even think about. And because of the sheer volume of trading going on around the world of all of these things, you have to have a market maker. Otherwise, it would bottleneck. You'd never get you'd never get anything. So one of the things that the market maker is in charge of, if you bought that $200 call, and what if price went to 210 and you said, I don't want to sell the call. I want the stock. So for those of you that have forgotten what an option actually is, an option is a contract that gives you the option to take possession of 100 shares of the stock per contract that you own or that you bought. Right? Well, where do the shares come from? Who's delivering the shares to me? I want to exercise my right here. I want the stock and I want it now. Thank you. Market maker. Where does the market maker get the stock from? So now watch this very closely, ladies and gentlemen. This is part of this thing that you really need to understand. Okay? If I bought a 200 call contract, you have to pick the strike price. and you have to pick the expiration on every contract, right? So it's about to expire on Friday, it's Thursday. I want the stock. I'm not selling my contract. Price went all the way up here. I want the stock. And check it out. Let's say I have one, okay? I want my 100 shares of the stock, and I want it, of course, at 200 because that's the strike price of my contract, so that's what I'm getting it at. But price is at 210. And I tell the market maker, hey, give me 100 shares at 200. Do you think the market maker is then going to purchase stock at 210 to then deliver it to me for 200? I don't think so. And lose $1,000 in the process, right? They'd lose $10 times 100 shares. They would lose $1,000. Well, it's not like the market maker is just sitting on a pile of inventory called shares where they go, oh, Michael wants his 100 shares. Murray, can you package up 100 shares and ship them out to Love? Yeah, he wants them. He's in Charleston. It doesn't work that way. So what the market maker must do, pay attention, guys. Try to stop the chatter in the chat so that you got the new people can focus. What the market maker has to do is anticipate the move up. This thing right here. See these dotted lines right here? They have to try to anticipate that move and buy at 196, 196.50, 197, 198, 199. They got to buy blocks of stock at these levels just in case Michael wants to take possession of his 200s so that when price goes up to 200 and they deliver to me at 210 and price and I want delivery of my 200, look what they did. They bought it when it was this so that if that happens, they can do this. So that really important to understand this now. Okay, I'm going to change colors here. Okay, if this happens, then when they bought this at this price, they can deliver it to me at that price. If this happens, then they can deliver it to me. Everybody understand?
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comment section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.